The economy is still growing. That's according to the folks at the U.S. Department of Commerce. They reported that fourth quarter GDP grew at a 2.9% annualized rate from October to December 2022. That was slightly lower than the 3.2% rate from the third quarter, but slightly above some Wall Street expectations. All in all, the economy is not crashing. And as we've seen, the pace of inflation is coming down. These are good things. After the overstimulated economic periods of late 2020 and all of 2021, when there was a 5.9% jump in GDP, growth is slowing, and inflation is too. But it's not to the point where industries have ground to a halt or a bad economy has put hundreds of thousands of people out of work. Certain businesses are making moves to keep margins up, like laying off workers. We've seen this from leading companies in the tech sector. But on balance, the jobs market is still tight, with weekly jobless claims also checking in today at their lowest reading since April. Things are okay, for now. The timing here is also important. This GDP number arrives just a few days before the Federal Reserve heads into its two-day policy meeting this week. Next Wednesday, we'll learn the central bank's decision on interest rates and other economy-manipulating maneuvers, plus its thoughts on future decisions. All of these tend to influence stock prices. Bond traders are betting with near certainty on a 25 basis point hike from the Fed next week, which would take the federal funds rate to a range of 4.5% to 4.75%. That's one or two raises away from their current projected terminal rate, just north of 5%. That means anything else would be a market-moving surprise. If the Fed doesn't raise rates at all, it could push markets higher. Meanwhile, a higher hike or some confusing comment or surprise from Fed Chair Jerome Powell in his post-announcement press conference could send stocks tumbling. The big question when it comes to the Fed is not what it will do at this meeting. Officials have been telegraphing a 0.25% hike in rates. The market wants to know what the Fed thinks about the economy right now and whether it will keep raising rates as it has done for almost a year now. Practically, Fed officials will, hopefully, be weighing the benefits and risks of higher rate policies and what more expensive dollars and a year of interest rate hikes will do to the economy in the future. They can't know for sure, though, of course. A relatively solid GDP doesn't give the Fed any new reasons to change its plans. These revolve around getting its benchmark lending rate to a sufficiently restrictive level, currently projected near 5%, and hold it there to see what happens with inflation. At the same time, certain areas of the economy are already seeing deflation, so as we've said before, the Fed is threading an interest rate policy needle, and it has to manage this delicate needlework in a critically important point of a roughly $26 trillion quote. That is the complex U.S. economy, the largest in the world. Typically, a GDP rise of around 2% or 3% per year would sit all right. But inflation is still well above normal levels at 6.5%, according to the latest Consumer Price Index. So the central bank has said it will do what it can to cool price increases to a point where inflation doesn't run near 4-year highs anymore. And that's to piledrive demand most directly in real estate and other rate-sensitive lines of business. Sounds too simple. What will they actually do? Investors are betting on the Fed going with a 25 basis point hike, and Powell signaling we're not done fighting inflation yet, with at least one more hike to come in March. Admittedly, this is probably the consensus view, and there's always a chance we hear something different. Maybe inflation is going to come down dramatically to around 5% in the next few months, as measured by the CPI, and 2% or 3% by mid-year. The Fed should be happy about that. If they do their job correctly, they do 25 in February and 25 in March and stop. The fear is the Fed really F's up, and they continue to raise rates because they continue to drive the car looking in the rearview mirror. And they raise rates too much, and it puts us into more of a moderate recession, as opposed to a mild one. That's the downside risk. At this point, you really have to watch the Fed, and that's going to drive this market. But if I'm wrong and the Fed actually does not what they're supposed to do, this market's set to take off. So we will watch next week and report to you on the Fed's latest decision, how the market reacted, and what that may mean for your investments Wednesday.